Hello, and now we proceed with step number 3 of IFRS 15, revenue recognition from contract with customers. So, as just stated earlier, that first of all, you have to check whether a contract exists. And the second step is just to identify your performance obligations. Now, after having done that, the third step is to determine the transaction price. What is the transaction price and how do we do that? Actually, there are several considerations how to put into account before reaching that conclusion. We'll see one after another, but for today, we'll just use about 10 to 15 minutes so that we just take a look at a single one with an example. So IFRS 15 defines the transaction price as the amount of consideration the entity expects in exchange for satisfying a performance obligation. This is what actually a transaction price would mean. You need to deliver something to a customer and you expect a compensation in return for your provision of service or deliverance of goods. So that's what we call transaction price. So sales tax is excluded. You cannot include sales tax in a transaction price as we just saw at the beginning of the very beginning of the standard. So when determining transaction price, the following must be considered. So you have to consider the following 4 considerations. Actually, we'll just take a look at a single one. So one of them is variable consideration. How do you deal with variable consideration? In case you're provided with consideration that vary, that has a potential to vary, what consideration would you use? Actually, there could be a possibility that the consideration has to be increased or has to be decreased. So what would you do? That's what we're just going to take a look at. And then we'll proceed with the rest of the possibilities regarding the transaction price. So let's start with the variable consideration. And here we are, variable consideration. What are the variable consideration now? Now we say, if a contract includes a variable consideration, then an entity must estimate the amount it will be entitled to. You and the entity have to estimate the amount we're entitled to. Should I be entitled to all of it, or should I be entitled to just a partial amount of it? So the standard requires us that the estimate that we are just going to use can be included in the transaction price if it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. What do we mean by this? You have to record an amount that it is highly probable that there won't be a significant reversal of the revenue, because it will actually be nonsense that you have recognized revenue and then you come and reverse it and then you take it back from the income statement. That's why you say it is highly probable that a significant reversal in the amount of cumulative revenue recognized will not occur when the uncertainty is resolved. Actually, let's say you have recorded $100 million, but then during resolving, when the uncertainty is resolved, it is found that you have to eliminate maybe just $10. It's a very little amount, so you can just take all that $1 million, because the value that will result into the reversal is just actually it's almost immaterial compared to the true value. So that's what you have to do when we deal with variable consideration. And further, we are told that note that if a product is sold with a right to return, now this is another special case that you need to be aware of. When a product is sold with the right to return, you are selling a product to a customer and the customer has the right to return. That means if they return, you have to refund the money. So in that case, we say that the consideration is variable. You have received a certain amount already, but when the customer returns, you have to refund them back. So the sales you seem to have made now could actually have to be decreased due to the returns inwards made by the customer. So since actually you deliver the goods to the customer and gave the customer such a right to return, you have to incorporate that impact right away. So we say the entity must estimate the variable consideration and decide whether or not to include it in the transaction price. You will have to do that. No problem. Actually, you're just going to see an example. And the last point is the refund liability. Suppose a customer actually will return goods worth return the good that you sold to him for $20,000, then you have to make that refund liability, because it is a possibility that you have to refund that amount. So the refund liability should be equal to the consideration received or receivable that the entity does not expect to be entitled to. The amount that you feel that the customer will come back and claim should actually be the refund liability. So it's just like that. So after here, we can just go to an example dealing with variable consideration, and then we'll come and take a look at all these other factors, one after another: significant financing components, non-cash consideration, as well as consideration payable to a customer. So let's go directly to an example. Yes, example one, this one. Yeah, let's take a look at this example 4 here. And then we'll also come and take a look at another example, example 5. And after here, actually everything will be fine. So let's take a look at the first example. Variable consideration. Transaction price is a variable consideration. The question says, on 1st December 20x1, on 1st December, Najib provides a service to a customer for the next 12 months. And the consideration is 21 million. So the full consideration for 12 months, that is to the 1st December, to 31st, actually it will be to 30th November of the year 20x2, the next year. Najib is entitled to an extra 6 million if after 12 months, the number of mistakes made falls below a certain threshold. So Najib, as a provider of service, is entitled to a further $6 million in case the number of mistakes falls. That is, in case his performance actually improves. So here we are told, discuss the accounting treatment of the above in Najib's financial statement for the year ended at 1st December 2021. Actually, to the end of the year, this was 1st December, and this is at the 1st December. That means 1 month has elapsed. Now we are given conditions. Condition A here said that Najib has experience of providing identical services. Najib has experience providing identical services in the past, and it is highly probable that the number of mistakes made will fall below the acceptable threshold. So it is made clear here that it is highly probable that the number of mistakes will fall below that threshold. So there is a high possibility of the mistakes falling, and actually Najib receiving that $6 million. So we will have to incorporate that $6 million too. And that's why in the solution here, note that we are given 21 million that was given, that wasn't variable, but only 6 million was variable. That's why we say that the 21 million consideration is fixed. So no compromise about that. It's very, very obvious. What about the 6 million now? The 6 million consideration that is dependent on the number of mistakes made is variable. It's a variable consideration. And now if it's variable, you just go and check the probability. We are told that it is highly probable. And actually, even before, the question stated that Najib had experience. So if Najib had experience, it was actually evident that it would be probable that the mistakes will fall. So Najib must estimate the variable consideration. And it could use an expected value or most likely amount. When actually estimating these things, you can use expected value, that is a long run average, or just a most likely amount, depending on the circumstance. So we say, since there are only two outcomes, you either do not add it or you add it in full. Then a most likely amount would better predict the entitled consideration. In case we are given possibilities and probabilities, and that this would be a long run average, you could have used an expected value. So actually, we would have to add 6 to the original, to the fixed consideration, to end up with $27 million. So that's what we have to do. That's why when speaking of A, we say Najib expects to hit the target by most likely amount. The variable consideration would be 6. Actually, the end result would be 21 million plus 6 million, which would give you a total of 27 million. Now, this is what we would have actually used as a transaction price. But now read here, what are we required to do? We are told to discuss the accounting treatment. This was done at 1st December 20x1. We need the treatment is at 31st December 20x1. So because of that, we would actually have to ask ourselves, this contract of 27 million is for 12 months. So 27 million is for 12 months. What revenue should have been recognized just over 1 month? Because from 1st December, the 1st December is 1 month. So you would take 27 million over 12 times 1 month, ending up with 2.25 million. And this would be the revenue to be recognized in the financial statement. So it is likely that the performance obligation will be satisfied over time. And so the revenue recognized in that year would have been 2.25, just like that. And then you go to scenario B. Scenario B here stated that Najib has no experience of providing this service and is unsure if the number of mistakes made will fall below the threshold. Is unsure if the number of mistakes made will fall below the threshold. So if he is unsure, that means it is not highly probable that mistakes will fall. And so 6 million will have to be discarded. So we only have to use $21 million. So that's why here we say, depending on the estimated likelihood of hitting the target, the variable consideration would either be estimated to be 0 or 6. But it's obvious that it's unlikely. So if it's unlikely, we would disregard that 6 since Najib has no experience of providing the service, and therefore the transaction price would be only 21 million. So as usual, 21 million, this 21 million over here is for 12 months. Now you would ask yourself, how much would have been there just for 1 month? So having done that, you would have to apportion this 21 million over 1 month that has elapsed, ending up with 1.7 million. So we would have to recognize the revenue recognized of 1.75 million is for this year end. So that's what I actually wanted to speak of. And then let's just go to another example of transaction price variable consideration. This one here, just be patient a bit. So here we are told that Kazoka enters into 40 contracts with customers, 40 contracts. And then each contract includes the sale of one product for $1,000. So each contract has a sale, actually will involve a product being sold for $1,000. So what would be the price expected for 40 contracts? That means 40 contracts times $1,000 per contract, ending up with $40,000. So we say the cost to Kazoka of each product is $400,000. So Kazoka incurs a cost of $400 and actually ends up selling the product in the contract for $1,000, expecting a profit of $600, right? 1,000 minus 400. And then cash is received up front and control of the product transfers on delivery. So actually, you have received cash. Kazoka has received cash and he has delivered the product. So having done that, Kazoka actually has satisfied the performance obligation by delivering the good, the product to the customer. And so Kazoka is well entitled to record a revenue, to recognize a total revenue. But here we are told customers can return the product within 30 days. So that is an agreement. You have entered an agreement. Kazoka has conferred the right to a customer to return the goods, the product within 30 days. And that means Kazoka should make a refund, should provide for a refund. What if the customer returned the goods? Kazoka will have to pay, and this creates an obligation. You know, an obligation, or simply speaking, a provision, is per I-37. When speaking of a provision is a present obligation as a result of past events. By Kazoka selling goods to a customer and agreeing and conferring the right to the customer to return the goods, Kazoka has actually incurred an obligation. So actually, a provision also said that there is an expectation of outflow of future economic benefits. Of course, Kazoka expects to refund the customer for the goods returned, but also actually the provision should be able to be measured reliably. We can actually measure reliably the amount that we will have to return. So we say that Kazoka can return goods in 30 days to receive a full refund of his amount. Kazoka can sell the returned goods at a profit, so the goods are just fine. And that we are told, Kazoka has significant experience in estimating returns for this product. So Kazoka has great experience. That means that he can measure the provision reliably. So it estimates 36 products. It estimates that 36 products will not be returned. So if 36 products will not be returned, and actually Kazoka sold a total of 40 products in 40 contracts, that means that only 4 products are expected to be returned, and this is a reliable estimate. And so we would have to make a refund for the 4 products that we expect to be returned by the customer. So what are we required to do? We are told here that how should the above transaction be accounted for? Now, how are we going to account for this above transaction? So this is what is going to happen. So just ask yourself, the fact that customer can return the product means that the consideration is variable. Very, very obvious. You have received something, but it can reduce. So using the expected value method, an expected value actually uses probability. The estimated variable consideration is 36. Of course, for this case, we're not given probability, so we just use a normal expectation. So with our expectation in that, 36 products will actually not be returned. So this will be our variable consideration because we do not expect to remain having sold 40 products because 4 would be returned. So we just remain with 36 products. And this gives you a total of $36,000. That is 36 products times 1,000 for 1 product. And so we are told the variable consideration should be included in the transaction price. So you have to include this variable consideration in the transaction price, not all of it, not that one for 4 products. Based on Kazoka's experience, it is highly probable that a significant reversal of cumulative amount of 36 will not occur. Actually, we have said that what will actually occur is the reversal by 4 because 36 won't occur. That means only 4 units will be returned. So actually, that refund liability should be based on just 4 units. That's why we say the revenue of 36 would be recognized, but also we would put a refund liability of 4,000. That means these are sales that will be returned. It's just like the sales inwards. So just take it that way. 1,004 products which are expected to be returned should be recognized. So you have to recognize revenue for $36,000 and then refund liability for 4. That's what we'll have to do. And then we are told Kazoka will be recognized the inventory transferred to its customers. It's obvious the customer has returned goods to you. So it's very much obvious that you would have to recognize the inventory. And then we're told also it should recognize an asset of 1,600. That is 4 products times 400. You know, 400 means what? You sold goods to a customer for 1,000 and the actual cost was just 400. So it would mean that the goods would be returned. So those goods would be recorded at their original cost. That is 4 products and each product costing $400. So you have to multiply them and have 1,600. So inventory transferred would be recognized, and then we'd have to recognize an asset of this value, as well as a corresponding credit to cost of sales to omit sold inventory for the right to recover products from customers on certain refund liability. Let me tell you one thing. This issue is actually very, very simple. All you have to do is this one. You do not have to apply such concepts. It's just a normal thing. Let me show you here, and actually you won't believe what I'm just going to do. So presume that you would sell all the products. So the total revenue would actually be 1,000 per unit times 40 contracts, giving you a total of $40,000. And then you know that actually the cost of sale that you would have sold your products, actually your products were costing 400, but actually you sold 40 of them. So multiplying this, it would end up with actually $16,000, just like this. So it would be just like this and everything would be fine. But now we are pretty sure that 4 of the products would be returned. So if 4 of the products would be returned, we'll have to make some changes. So first of all, presume that no changes. Suppose if there are no returns to be made, no returns. If no returns, actually, for the revenue part, I would have debited trade receivables, right? Trade receivables. Just like in normal accounting studies, your previous accounting studies, debit trade receivables by 40,000 here. Correct. Yes, and then I would have to credit revenue. I would have to credit here by actually revenue. Revenue by how much? By 40,000, which is unlikely. I'm just assuming that there was no right to return. And then what should have happened here, down here? What should have happened down here is that I sold goods. I sold for 40 units, 40 products. So if I sold 40 products, that means this would all go to cost of sales. So I would say here cost of sales of 16,000 like this. And then I would have to credit, this is cost of sales. You have debited cost of sales, and then you have actually removed the inventory. So I would have had to credit inventory because I've sold it. So credit inventory by how much? By 16,000. This is what I expected to do. But now consider returns. Consider returns. If returns were to be made, this is what would have happened again. It's for sales, 4 units would be returned. So the revenue of 4 would have to be reversed. So when going to revenue here, we would have to reduce our revenue by how much? 4 times 1,000, that is 4,000. So I would have to debit to remove revenue as a credit nature. So I would have to remove revenue. I would have to remove revenue by actually 4,000. So I'll debit revenue here by 4,000. And then by debiting revenue with using 4,000, what would be the corresponding entry? The corresponding entry here would actually be to credit what? Because I'll remove revenue, then I would also have to remove this trade receivables. So I would have to say to trade receivables. Trade receivables is original, remove them by 4,000. Do you see the net here? What would be the net amount? Let's see the net. The net amount here is revenue of 40,000 would now change. It would be 40,000 minus this 4,000, which would give you $36,000, as we just saw in the question. Actually, trade receivables too, this was about revenue. Trade receivables too would have to change, and it would also be 36. Actually, suppose the customer paid. Let's presume that the customer paid. If the customer paid, this wouldn't have been trade receivables. Actually, it would be cash or bank. Let's say cash or bank. We would just say this one. So it would also remain to 36 because I would have to remit that amount to the customer. And here, let's use cash too. Here, let's use cash or bank. Just like this. So the customer returned the goods, we refunded the cash of 4,000. This is what we would have done. So that's why instead of saying credit bank, because we are doing this now, we do not know whether the customer will return the goods or not. So I'm not assuring myself that I'll remove something from the bank. So that's why I say here refund liability. Because I haven't actually paid back the money. So that's why I do this one. So you have to be very conversant with what I'm just doing here. So that's why if you look at the question, it just stated directly that the fund liability would be 4,000. It's just a normal accounting practice. Now let's finish up with other explanations in the question. Cost of sales, this one. Goods have been returned for 4,000, but the goods returned were having a cost of 400. But there are 4 goods which were returned. So 4 times 400 will remain with 1,600. Having 1,600 means that I would also have to revert this cost of sales. So I would have to remove from cost of sales new inventory. I would have to remove that inventory that I initially sold from cost of sales. So I would have to credit my cost of sales by how much? Cost of sales by 1,600, and then I would have actually to debit my new asset because the assets will be returned, the inventory will be returned. So I will debit asset here and write it as 1,600 again. So this would actually was going to happen. And that's why the actual cost of sales here, we use 16,000, but it would actually be 16,000 minus 1,600. 16,000 minus this 1,600, ending up with 14,400. I've just taken a full version of the situation, not just a part. So this is what you were supposed to do. But actually, the explanation here just goes directly to what the focus should be on. So actually, this is how we do the variable consideration. So take a look at those two scenarios, and then we'll just come back for the second possibility when dealing with when dealing with the determination of transaction price. We'll come to significant financing component, and then we'll take each part in turn until we finish. So that's all.